The Federal Reserve just cut interest rates for a second time this year, lowering its benchmark interest rate by 0.25% to a range of 3.75% to 4%. They did this despite having only a partial view of how the economy is faring because of this government shutdown, as the lapse in funding for government stretched into its fifth week. Until lawmakers reach a deal, the Bureau of Labor Statistics and other agencies have stopped collecting, analyzing, and publishing official statistics tracking the jobs market, consumer prices, spending, and a range of other metrics. Nonetheless, this move from the Fed marks the second consecutive cut this year and brings borrowing costs to their lowest since late 2022. The Fed referenced a weaker job market, referencing a slight uptick in unemployment and slower job gains in the economy. That concern about the labor market helped tip the balance towards easing, even as inflation remains somewhat elevated. However, the decision wasn't unanimous. Two members dissented, one wanting to hold rates steady and the other pushed for a larger half-point cut, either side of the spectrum. Alongside the rate move, the Fed also announced that it will end its balance sheet runoff in December, effectively halting quantitative tightening. Starting December 1st, the central bank will reinvest all maturing Treasury and mortgage-backed securities back into the government's debt market. That step comes after a growing concern that QT was straining short-term funding markets and raising banks' financial costs. Today's decision shows the Fed pivoting towards supporting growth and stability, even as data gaps from the government shutdown make policymaking more uncertain. If you want to keep up to date with the latest market developments, subscribe and check out our other videos.